Wow. Did I get the calls yesterday? Calling me on my personal phone, my personal email, and everyone wants to know how soon, how bad, and how long is this recession going to be? So we've been talking about housing and how it relates to the other asset classes, and we're going to talk about housing and the economy today because the two are certainly tied together. It looks a lot like 2008. Everybody's asking me to make a comparison between 2008. I was here 2000. I was here for 1988 too. So, and I was there for the 81. So I remember a lot of this, and there is a lot of similarities what's going on in 2008. Although with all the commercial problems we're having, I'm thinking it might be more towards like a 1988 through 1991, where commercial really led the way. But housing is certainly going to be at risk. We're going to have probably a commercial problem more so than housing. But let's get to my very first slide. Let's just talk about what we see. So is there a similarity between 2008 and the housing and the economy? Absolutely, positively. We absolutely see that. So I'm going to tell you that we've been talking ad infinitum about the fact that liquidity runs the economy. Without the fuel in the car just slows and stops. And that's what's happening to our economy. So, and there is a lag. It doesn't happen overnight. So once the interest rates and the liquidity start to go negative, that's where we start the countdown from. Now, we start talking about when did the interest rates go negative. And of course, the interest rates went negative July 5th of 2022. And there is a definite lag between when it starts and when it really starts being felt. Same with the interest rate increases. There is a lag. That lag for interest rates is 9 to 15 months. So when we get an inversion, the typical recessions really comes to for 16 months later. So that puts us still this year. Remember, my timing model is saying that the peak of the real estate asset class, the values peak in the third quarter of 2023. Third quarter starts in and today's the 28th, so third quarter starts in just a few days. So we're talking about something fairly close soon, that we're going to have the peak of the second peak and the final peak, and then it's going to start getting lower and lower and lower. And that's when I anticipate that prices will start coming down. Now, I'm not saying that they're going to waterfall down. I'm just saying that they probably will peak. And when they say peak means it doesn't go up anymore. So that's what we're looking at. But now, when the interest rates invert, and here it is, it inverted. Just look at this. You can see this coming out of Federal Reserve Electronic Data System. It inverted July 5th, 2022. It is as clear as a bell. You cannot miss the fact that happened. Let's fast forward 16 months, which is average. Could it be 14 months, 15 months? Could it be 18 months, 19? Of course it can. Nothing says it's absolutely perfect, but if we just counted 16, that brings us up towards Thanksgiving, 1st of December, right into the Christmas time frame. That's when I think we're really going to start seeing some major problems in the economy. I think it's going to start third quarter. It's going to get worse in the fourth quarter, and 2024 is going to be even worse. So what happened in 2006 during the great financial crisis? Well, it didn't invert anywhere near what it has inverted now. It inverted absolutely positively. It inverted 2006. And I'm going to tell you, take that 16 months later, that puts us into, that April-May timeframe of 2008. And I'm going to tell you, the economy was just the pits when we were there. But it only inverted a little bit. The difference here is we have inverted to a historical amount. I mean, we're down over 1% on the inversion. I don't know that we've ever made that. We might, if we look back to 1982 to maybe 1980, we can see a pretty strong inversion. I think we've gone past that. Regardless, it tells us that the severity is going to be fairly severe. Now, let me go on to my next slide, and let's just talk about that. So here, rates peaked in 2006. 2006, the market was slowing. So that was just getting to the very first peak. Rates had peaked, and then they started turning down. Didn't make any difference. The die was cast. Once those rates peaked, and once the cycle got to its completion and started to complete, it was over with. You could return those rates next to zero. It wasn't going to make any difference. And rates came down. This was the second peak. and down she came. So 2006, it took really to, if we start talking about, 2008, really was at the end of this December of 2007 was okay, but by the time we got to March, April, May, significant problems were in the economy. So that was like 16 to 20 months later, we had a major problem, and that was interest rates peaking. So far, what are we looking at? Well, so far, rates have peaked in October 27th in 2023. Now, is this the peak? I don't know. That's the trouble with statistics. We're looking forward. We're probably pretty close to the peak. I'm going to tell you, when you get 7% 30-year fixed rate mortgage coming from basically 2.5%, 3.5%, that is a major slowdown. That is a major, major problem. And it just takes all the buying out. So we start getting to the point where once you get up to 7% with elevated prices, people buy payments. Once you get into elevated prices, these things start rolling over. So I'm thinking that it's peaked, very, very similar to 2006. Remember, in 2006, it wasn't 6 or 7 months on the real estate market. Then the market was over with. So again, I'm thinking this goes right into our observations. I'm sorry, I've got 2023. This would be out at 2022, of course. So when we look at this, takes us forward. If we come forward a year, that takes us right into our timing model, and we are just thinking that this is just perfect. So it puts us into the jeopardy. So I think we peak in the third quarter of 2023. The fourth quarter of 2024, we start recognizing we have major problems all throughout the economy. So that's the when. And it starts rolling over from them. Let me go to my next slide. Excuse me. Now, when we talk about average lead time, we peaked here in 2006. It inverted in 2006. We didn't start having that problem until 16 months later. Here in July of 2022, 16 months from July of 2022, right there, and you can see it is very pronounced. We start looking at the late fourth quarter of 2023, and we're going to have major problems. Now look at the peak liquidity. Now we're talking about not only going inversions, now not only do we have interest rates inverting, but now we have liquidity peaks. So in March 2022, clear as a bell, coming out of Federal Reserve electronic data, you can see the fact that the Federal Reserve had been adding liquidity, trillions and trillions and trillions of dollars of liquidity. Then they started to gradually slow down, and they peaked March 2022. So what does that peak mean? It means there's no more going in, and they started to withdraw. So in the last couple of years, when we started getting into last couple of months, we started getting into the fall of 22. That was terrible, terrible marketing. Here in Phoenix, we had listings almost doubled in like 3 or 4 months. So it happened fairly quickly. Let's see what happens. So in April of 2023, it is very, very evident that we're losing a lot of money supply. Not only that, but a lot of the banks are losing money supply because they now have an alternative to the banks. They can go into short-term treasuries, 30, 60, 90-day treasury bills are giving anywhere from, they started at 3, but now they're around 5%. So money is coming out of the banks, going into treasuries, and that's our money supply is decreasing at an alarming rate. That's at negative 12% in April of 2023. Now, the Federal Reserve would have known this long before then because they get all the statistics. They have some of the best research in the world. So we're getting this, and it's lagging, of course. We don't necessarily see this for a couple of months, but the Federal Reserve is going to know that in real time. That's just what's happening. Now, what's going on with the banks is that the banks are losing all these funds coming out of it. Now, that's what happened with Silicon Valley Bank and Republic and Signature. People started taking their deposits out. The banks became insolvent because they didn't have any cash. They were forced to sell loser bonds. They were being very conservative. They bought bonds. But you know what happens when rates go up? Bonds go down, and they were forced to sell. And in 3 weeks, the banks had lost $360 billion of deposits, and that was the last week of April. They had $113 billion taken out that week. So that's what happened to Lehman Brothers. So Lehman Brothers in 2007 had a record share price, $86 in 2007. And I'm going to tell you, 18 months later, in 2008, it filed for bankruptcy. And that's how quick this can turn. So in Bear Stearns, JP Morgan bought Bear Stearns for $2 a share. And that baby had been worth billions of dollars beforehand. And Washington Mutual was sold to Chase Bank again. And they had had a record in 2006 of $3.8 billion in profits. And less than 2 years later, they're bankrupt. So that's how quick it can go. Now, between 2006 and 2012, you can take a look. There is no liquidity explosion, consequently, no liquidity drain. When you get up here to, and this is really just around a COVID, so this would have been like 2020, there's just an explosion in liquidity. So now you've got a major problems. We not only have interest rates that were at an all-time historical 5,000-year low, and they're going up. So that is going to put a tremendous brake on the economy. At the same time, we've put in trillions and trillions and trillions of dollars of liquidity into the economy. What do you expect is going to happen when you put that kind of money in? That also explodes. So now, not only do you have interest rates that are down and now have to come up, now we've got liquidity being drained. What do you suppose that is going to do to the economy? We didn't have that liquidity in 2006 and 2008. It just wasn't there. This is a new phenomenon. So not only did they have interest rates very similar to us and inversion like this, but they did not have this liquidity. And this liquidity drain puts a whole different aspect on. I think that is going to be a multiplying effect on a downturn. So I think it probably has potential for being much worse than the 2008 great financial crisis. And here's what happened. I'm going to tell you, we are enjoying this. This fits perfectly into my model. We talked about this yesterday. But the Federal Reserve starts seeing this Silicon Valley Bank and the Signature and Republic and Credit Suisse start to collapse, just like Lehman, just like Bear Stearns, just like Washington Mutual. And they got scared. They put $391 billion worth of liquidity into the market in 1 week, just 1 week. And right now we are enjoying that. We've enjoyed that. So the real estate market popped back up, and the stock market went to another spike. Now, everyone is saying the stock market, that is a bear market rally. I kind of agree with that. And I'm going to tell you, this spike in the real estate, we came down 10.6%, and we've recovered 5 or 6%. That is textbook perfect. That's exactly what happened with this liquidity spike, and it really popped the market. And I think it's going to roll over. I still think in Q3 we are going to see the very top of the market, and it'll probably be the top for 16 or 17 years. I expect us to roll over fairly significantly. So how long is this sugar high going to last? Well, not long. We probably have 30, 60, 90 days. This is a huge economy. Remember, $100 billion of this went over to Switzerland, to the Swiss National Bank, to backstop Credit Suisse and the UBS buyout. So it really wasn't $391 billion. It was still fairly significant. We got $291 billion, but $100 billion went to Switzerland. So you've seen Europe pop up a little bit. And so how long is it going to last? Probably running out. There's nothing here that says that our call for a Q3 peak is still not accurate. We're going to know in 90 days. Maybe I'll have egg on my face in 90 days, and everyone will say, "Well, that was stupid." Maybe, nothing says that that can't be different this time. Those are the most expensive words in the English language. It's different this time. Maybe. I could very well be wrong. So we have seen this bounce happen before. It happened in 2006 to 2007. And then it rolled over, and that was it. We saw this before. It happened in the great financial crisis. We're thinking that it's going to happen. We're going to roll over here pretty doggone quick. And let me just take a look at this great slide. I've used this so many times. I really, really like this from Charles Hugh Smith. He just did great work. And he's talking about retracement. He's talking about the housing bubble. Now, you've heard the everything bubble. Absolutely everything bubbled. Bonds bubbled. You saw stocks bubble. You saw gold pop up. You saw mortgages pop up. You saw real estate pop up. Everything popped up from everything went. So it needs to retrace. It needs to correct. It needs to get all those excesses, those trillions and trillions and trillions of dollars of liquidity that our Federal Reserve and government put into the economy. We have to default on a lot of that. It's going to be a very, very nasty time, and I think that's coming to you fairly soon. Now, in this work by Charles Hugh Smith, he thinks that we could easily see 30%, and I agree with him. I think we can easily see 30%. Could see more than 30%. Could see 35%. Remember, if you don't have any liquidity and people buy payments if they can't buy a property because there's no loans, and keep this in mind that we have seen a significant slowdown in underwriting. They have made it much more strident to get a loan, so it makes it fewer and fewer people are going to qualify. Fewer people qualifying. That puts stress on a market. So I think it could come down 30-35% in very good marketplaces. Could it come down here in Phoenix and Plano and Dallas, Miami, Tampa? Yeah, it could. Just depends on the severity of recession. I think we're going to have a fairly severe recession. We've talked about how it could come down to 60% in other marketplaces. And keep in mind, I have always said that we're looking at a regional real estate market. Now, a lot of my data is national because we use the Federal Reserve electronic data. We try and get really good data because it should be very, very good data, except that sometimes we've got a 60, 90-day lag. However, on a regional basis, each region is going to be priced a little differently. So when you start talking about San Francisco and Chicago, San Francisco is already down 17, 18%. By some market measures, I've seen up to 30% already. And we're just now starting. So if you're in San Francisco, you could could we go down 60 or 65%, retrace the entire bubble? Yes. Yes, we certainly could. So I would say brace for impact on this. Now, if this is such great news, if the first-time home buyers are just priced out of the market during this great run-up, during this FOMO, we had so many people paying cash and putting 50% down, that these poor first-time home buyers that were getting an FHA or a VA or 3% down, 5% down, they kind of got bruised a little bit. They couldn't buy a house because the other buyers were better buyers. So the first-timers became tenants again. Well, that's probably a pretty good thing. So now that you're a tenant, I'm going to tell you in about 18 months, you're going to have one heck of an opportunity to buy some really, really good properties. So let me go to this one. I've been harping on this and harping on this and harping on this. We have failed cities here in the United States. Failed cities. Baltimore is a failed city. Detroit is a failed city. Can Chicago, Milwaukee, Minneapolis, Los Angeles, San Francisco become failed cities? Portland become failed cities? Yes, they can. So if you've got investment properties or a business there, you have to start thinking, what is this going to look like in 5 years? If you have a property in one of these cities that's at risk, and they are at risk, you need to start thinking to yourself, what am I going to do? Because these are the ones that if you want to see a retracement of 60%, this could happen in these cities. And I haven't put them all on here. I mean, St. Louis would certainly be a target for a huge retracement. Philadelphia has been in the news all week. They've been having problems. I mean, social problems and crime and drug problems. So if this is where you live, then you really need to start thinking, do I want to stay here? Is this where I want to put my family future here? Is this where I want to stay for the next 10, 20 years? Because the market is going to be long. We keep asking how long. We probably will have 4 years of recovery. Last time during a great financial crisis, and even into the 88 and 90, it took about 4 years for the market to really level off, to get rid of all the excesses. And let me tell you, there's just tons and tons and tons of excesses. Here in Scottsdale, Arizona, we have 4,200 furnished vacation rentals available. Now that's a big excess. We're a great vacation destination spot, absolutely, positively. But can we compete with 4,200 of them? Probably not. I think that's an excess. So these excesses have to be worked out. Things have to be done. So if you've got a vacation rental, maybe it goes into a long-term rental pool. Maybe you sell it. But it's some kind of resolution is going to happen. So you need to talk to your broker, talk to your financial advisor, talk to your accountant. Certainly discuss this with your spouse. You're welcome to talk to me about this. I'm more than happy to sit down and go over these things with you. I mean, we do this on a day-by-day basis. We'll do some consulting with you. Now, you may or may not know that the IRS allows their taxpayers to do a tax-deferred 1031 exchange like property for like property. Virtually any real estate is allowable if it's held for investment purposes. And that means that if you've got $1 million in California built up in equity in a property, it's capital gains, and you say, oh man, if I sell that, I'm going to lose, $300,000, $400,000. Well, you can defer that and put that anywhere in the country you want to go. You can go to some of these great markets and not have a tax event. It gets deferred to the next property. That's called an IRC 1031 exchange. Perfectly legal, fairly inexpensive to do. Very, very easy. It has some rules to do, but really, really easy to do. Perfectly available for you. I highly recommend that you do that, particularly if you've got these properties in some of these at-risk cities. So I'm going to tell you, this is where I'm at. You are welcome to find me. I'm here to answer your questions. I answer my phone, so you're welcome to call us. If we can help in any way at all, we're here to do that. My very best to you.